Welcome back to another episode of Palisade Radio. I'm your host, Karim Mutlu, and on today's show, we welcome JC Parets, who's the founder of AllStarCharts.com. Welcome to the show, JC.
Thanks for having me.
Let's begin by talking about how you began your career and also talk to us about your experience of 2008. I understand that you had passed all 3 levels of the CMT program at that time. However, 2008 taught you that you needed a few bull and bear market cycles to really wrap your head around the fact that perhaps we don't know anything at all, no one does, and that the market is going to do what it wants and doesn't care what we think. Can you talk to us about that?
It's funny. I learned well before 2008 that I had a lot to learn. You know, it was probably like halfway through like my first technical analysis book. I'm like, oh, I can do this. And next thing you know, you're trading call options based on MACD crossovers because it seems like a good idea. And then you're like, oh, as it turns out, it's not quite that simple. In fact, so I had completed my CMT. I probably started the process in 06, 05, 06, and then I finished, I got notice that I had finished my CMT level 3 done with in the summer of 2008. So, you know, I was almost done by the time, you know, I mean, quite frankly, I mean, looking at back at that now, but at the time, in the first week of January of 2008, when we broke, I mean, that was just a massive head and shoulders top in 2007 in the Dow Jones Industrial Average. And, you know, now fast forward a decade later, you know, now that I'm much more experienced, it's not quite as simple as just looking for a head and shoulders pattern and shorting everything, and that's always going to work. It doesn't work that way. It just so happened that time it did. So because of the CMT, you know, we did very well in 2008. And, you know, we caught it early, very early. And it was really because of the technical analysis. So, I mean, it really came in handy at the perfect time because obviously who knows what that my life would have, how that would have turned out had 2008 been a disaster for me, and, you know, who knows.
Very good. Okay, if we move on to the gold market, let's talk about how you view gold and if you currently see it in an upward trend. Is gold more of a currency story rather than anything else to you? And if so, how do you view gold and the dollar and the importance of the potential stronger dollar down the road? Do you see that forthcoming?
It's funny, you know, we've been bullish gold and precious metals, silver since the end of last year, right? That was has been a big thesis coming into 2008, buy precious metals, buy precious metals. The funny part is that a big part of that thesis, of that bullish thesis in precious metals was a weaker US dollar, right? And just looking at the US dollar index, I mean, we can compare the dollar to a lot of currencies and make our judgments, but just as look at the dollar index, it is flat the entire year. So it's kind of like an interesting sort of situation where gold and silver have shown so much relative strength in the face of a dollar that hasn't necessarily been rising in the index level anyway, but certainly has not been falling like traditionally is the case when gold is going up, right? So it's like, okay, how do we interpret that now? Like, okay, great, we got the gold trade right, the dollar we weren't right, but we weren't wrong either. It just didn't do anything, but we got the gold right anyway. So great. Now, fast forward to where we are. So what does that mean? Now that we have new data, how do we interpret that? And the way I see it, a couple of different ways to look at it. Number one, just the sheer resiliency of precious metals in the face of a dollar that isn't falling, number one. But number two, if the dollar does start to weaken, does that accelerate the uptrend in precious metals? And I would argue that it would. Now, my other argument would be if the dollar index starts breaking through 98, this whole 9-10 month period, whatever it is, has just been a consolidation within an ongoing uptrend. Really, I mean, it's really been, about 10 months. And is that what it is? And now we continue higher and retest the highs from late 2016, early 2017 in the dollar index. And if that's the case, what does that mean for precious metals? I'd argue that's not good for precious metals, right? So that's really kind of where I am. So to answer your question in 2 parts, yeah, I think it's a currency story, but it hasn't been so far this year. So there's the bet you're going to make is that uncorrelated movement, the bet that we want to make that continues, or that it reverts to traditional correlations. And I think the better bet is that it reverts to traditional correlations.
Okay, if we look from a macro perspective, do you see the potential of a global recession happening anytime soon? And if this is the case, how would you position yourself to profit, JC?
Recessions has to do with economics and a slowdown in GDP growth or whatever, however they define it these days. I think it's always changing and depends on who you ask, like a recession, right? For me, we've done the work. I mean, a lot of people have done the work. You go back, the stock market leads recession. So you don't know that you're in a recession until the stock market has peaked a year ago, right? You don't know that you're out of a recession until the market's already bottomed 6 to 12 months ago. So it doesn't do you any good on that end either. So for me, I think the wiser thing to do is to look at the leading indicator, the stock market, which is the smartest market of them all. Like that's the smartest, the best information we can get, because you could listen to the news and they have their objectives and their opinions that has nothing to do, with reality, right? They're just opinions from different people. And you could look at surveys and all sorts of different things, and you could look at these GDP numbers and jobless claims that are going to get revised 100 times. You could do all that stuff. Or you could see how people are actually positioning themselves and what they're actually doing. No one's opinion. These are just facts. Money's moving out of this. It's moving into that. There's no lying. There's no opinions. There's no illusions. These are the only things that matter. And when the smartest money in the world recognizes that there's going to be a slowdown, money starts coming out of the stock market in anticipation of that. So if you start to see new lows, like for example, you think a recession is coming, for the recession people, if that's going to be the case, what is most likely going to happen? That the S&P 500 is going to make new relative lows, new 52-week relative lows compared to both gold and treasury bonds. So if this is going to be a real bear market, then the stock market can't just go sideways. It's going to start having to complete major topping patterns relative to other asset classes, relative to their alternatives, gold and treasury bonds being two of those, obviously. And if we are down to the December lows, December 2018 relative lows, if you look at a chart of SPY, which represents the S&P 500, and let's just say GLD, which represents the gold index, the gold ETF index, you divide one by the other, we are down to the December lows. If you do the same with bonds, compare SPY to TLT, the most liquid bond ETF index, you divide that, and we're back down to those December lows as well. So on a relative basis, we are near very, very critical levels. And if those start to break down, I think that increases the likelihood of a recession for sure, because I think that's bearish for stocks, and then a recession may or may not follow after. But if you're in the camp that we're going to see a recession, that's probably one of the things that you're going to need to see to confirm your thesis, at least one of them, one of many. But for now, that's the most actionable nearer term sort of thing we're looking at.
Okay, JC, you are well known for being a technical trader, so it'd be interesting to go a few of the key indicators that determine how you read a chart. Your timeline, I understand, is usually weeks or months. So do you follow such indicators as the RSI and the momentum as part of your tools? And when you first started trading, did you tend to overuse many different indicators to confirm and try and reconfirm everything you were seeing? Can you talk about that?
People ask me, JC, what's your favorite indicator? My favorite indicator is price. And I think that just goes unnoticed, because something that as human beings, we have a flaw where we like to overcomplicate things. Things that are very simple, they don't, we tend not to trust them. I think they have to be complicated for us to be attracted to the situation, which is silly, right? Keep it simple, stupid. What's the most important indicator? It's price, right? That's the one thing. Everything else after that is just a supplement to that price behavior. That's the most important thing to sort of realize. Whatever it is you look at, moving averages or volume or RSI, whatever it is, all of that is a far, far, far second to what actual price is doing, right? So let's just start with that. And then as my supplements, I like momentum and relative strength. I get to talk to investors all over the world all the time, buy side managers. What they're looking for are stocks showing momentum and relative strength, right? Relative strength is when one asset is outperforming another. So like, a good example, here we are at the end of August and the S&P 500 has gone nowhere for 18, 19 months. Right? What's the count at this point? Do the math. I guess in 19 months of just sideways action in the S&P and the Dow, right? Russell 2000's down from that. Mid caps are down. Healthcare is flat to down. Financials are down. What's the one area that's up, or one of the few areas that's up, other than some of the defensive areas like utilities and REITs? What's up? It's technology, right? That's one of the few offensive sectors, if you will, that has been positive. But what's really interesting is the relative strength. So that's relative strength in and of itself, that the tech has been outperforming the S&P 500. But in addition to that, look underneath in the sub-industry groups like healthcare. Healthcare hasn't done anything. Right? Biotech, pharma, just gross performance. However, the medical equipment stocks have been shining, right? The Medtronics and Abbott Labs of the world, they look great and continue to look great. And the whole subsector looks great. But what's interesting is that they look like tech stocks. However, they're not tech stocks. They're in the healthcare sector. But underneath the healthcare sector, there's a tech area. And we're seeing the same thing in financials, right? Bank stocks, terrible, right? Flat to down, all of them. One's worse than the next. But in the more technology area, like mobile payments, things like Visa and MasterCard, like these stocks look great. So that's really the relative strength that just happened to be sort of tech related that we're seeing underneath the surface in other sectors that are underperforming, right? So that's relative strength. In terms of momentum, a lot of people, I know a lot of smart people use ROC and MACD and all sorts of stuff. Me personally, I like a RSI, 14-period RSI. So if I'm looking at a weekly chart, it's a 14-week RSI. If I'm looking at a daily chart, it's a 14-day RSI. And I use it really for confirmation of trend, looking for divergences, and really trying to figure out what sort of range momentum is in. Is it getting overbought in an uptrend? Is it getting oversold in a downtrend? Right? What's going on? And that's really it. I don't look at volume. I rarely use a moving average. Like I use a 200-period moving average, like Paul Tudor Jones style. Like, are we above it or below it? I look at the direction of it. But the truth is, I'm using that less and less frequently as time goes on, to the point where ultimately I'll remove it completely. Like I have other tools like volume and the 50-day moving average. Like I haven't looked at those things in years, so I'm not one of these people that's trying to add things to my arsenal, but in fact, I'm trying to remove them over time and make things cleaner and simpler and easier. And I have found that to be a huge advantage for me over the years as I've grown older, which is why I'm guessing very soon I'm not going to use moving averages at all.
Excellent. Okay, you briefly mentioned Paul Tudor Jones, so I think it'd be interesting to find out, have there been any particular investors or books or authors that have actually shaped your mindset within your investment framework? Who has been or made any great impact on your career?
Yeah, there's no question. I get asked this question a lot, and really the truth of the matter is it's a combination of so many individuals before me and currently around me, my current colleagues. These are drinking buddies of mine, and we're talking about indexes and ratios and all sorts of indicators, and this is the stuff we talk about over drinks. And so I really am learning from everybody around me. I mean, originally, probably to my base, I was, I'm a John Murphy disciple through and through. His books were the first ones I read. I'm a very intra-market oriented guy. It just makes sense to me. So that, that top down sort of global macro intermarket approach certainly stems from him. Obviously, and then, he was really, a lot of the things he wrote was a derivative of, the greats, Edwards and McGee, that's the Bible of technical analysis. Everybody needs to read it 5 times, but a lot of what John Murphy's saying is really just a condensed, easier way to read a lot of the things in that book, which is the Bible of technical analysis. And those guys got a lot of their stuff from people like Charles Dow, which goes back to the late 1800s. And I have the Dow theory letters. I have the letters, copies of them, hundreds of them, and I read them all the time. And if you took the date out, you would never know. You would never know that these were written 130 years ago. You would think that these were written last week on Business Insider or whatever. You know what I mean? It's like really, really, really interesting. So those were really my guys. And then, just to name a few, I'll definitely do it a disservice because there's definitely a lot more. But just off the top of my head, guys like Rafa Campora, friends around me, Ari Wald and Chris Verone and Todd Sohn, anybody on that list, add that to people, Frank Capillari, Jonathan Krinsky. There's a million of them.
Okay, as we begin to wrap up here, JC, is there anything else on your mind at the moment? Anything else you'd like to share with our listeners today?
I get to be, it's cool being on this side of the podcast, right? And answering the questions. I'm usually the ones asking the questions, but, I ask people all the time, what sort of advice do you give and everything, like that. And one common theme that I get from, the smartest in the business is just sort of really just keep learning. Just understand that you don't know everything and you're never going to know everything. And that's just something to keep in mind. So it's always a work in progress, always question things. When you hear something, this is the way it always is. Well, you know what? Maybe it isn't always like that. Don't be afraid of new things. I've learned, as you grow older, you sort of get, you almost get scared of new things, right? Like, don't not only be scared of them, embrace them, learn them, even though maybe you'll never use it, but just play around with it. It's a new tool. Other people are using it. So even if you never use it, just download the app, play around with it. And if you hate it, and you were right, delete it, but at least you checked it out, and I think it's a good way to learn, cheap, easy, listen to podcasts, read books. You asked me about books, Market Wizards, read them all. They're fantastic. They're just interviews. Jack Schwager does a great job interviewing, the greatest traders all over the world. Definitely the one common denominator you'll find. What's interesting is that they all have different strategies, but the one common denominator you'll find amongst all of them is risk management. So that's really, really interesting that that's what they focus on. So I think maybe that's what maybe we should focus on too, right? So we do. And then just the behavioral finance stuff I think is really important because most people, it's not us against the market. It's us against ourselves. So I think understanding who you are and why you think the way you do, because of how we're built chemically, emotionally, I think is really, really important. And so anything on behavioral finance, read things like Sapiens, read things written by guys like Daniel Crosby and, read Thinking in Bets by Annie Duke, stuff like that I think is really helpful as well.
Fantastic. Okay, well, much appreciated today, JC. Thank you for being on the show, and hopefully we'll have you back again later in the year.
All right. Thanks a lot.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?